A very good morning. You're still watching Morning at NTV. I'm Arnold Segawa. Now, an earlier conversation that we did have last week was around the global oil prices. If you do follow the stock markets, the commodities market, you will notice that things like gold, silver, oil are traded on a day-to-day basis, or should I say even on a second-to-second basis. One thing that was striking last week, for the first time in history, oil, that's Brent, even WTI, was in negative territory. Now, what does that mean for you and I, ordinary Ugandans who wake up and get onto a motorcycle to get to work? To help us unpack this particular conversation is Abdul Chibuka, who's the CEO of True North. Abdul, you're a seasoned oil man from Tallow to Shell. We could have this conversation till tomorrow. Just give me a sense of what oil futures, getting into negative territory, what headwinds that actually does present.
So, good morning, viewers. I think there's two things I think that people need to understand. What drives the price of oil? So it's fundamentally, you could say, three things. First of all, the economy. So oil is a global product, so it's the global economy drives the price of oil. Second one is obviously the political environment globally. In this particular case, there are no political headwinds. The third one is the basic fact of demand and supply. So in this particular case, what caused obviously the negative prices in the US is largely the global economy and the factor of demand and supply. But just to again clarify before we go into the detail, the actual pricing that went into negatives was the WTI. That's the West Texas Intermediary. Now, that is the pricing for crude in the US market. So it's not as if the entire global oil crude market.
Not Brent.
Not Brent. So that is one thing that people need to understand. Obviously, what happens in the US, the rest of the world responds. So it was a very big headline. But it's not as if the entire global prices went crashing. Having said that, that was also a sort of one-day event in terms of the futures price. So what happens is that oil is traded on a futuristic basis. So that was the price anticipated for May, as the pricing for April was closing on the 20th. If you look at the prices today, I think it's about 20. So it has gone up again. Having said that, that is a trend we are likely to see because of the three factors I mentioned. The global economy is literally on its knees because of COVID-19. So we are likely to see the price of crude dampened for the foreseeable future.
Abdul, it gets interesting because there's a technical term, Contango, where the cost of storage happens to supersede the cost of an asset at the time. Now, was it getting a bit more expensive to store your oil than the price the futuristic price that we're seeing for oil prices in June?
That's exactly what happened in the US. So in the US, when they produce a lot of oil and also import oil. All of it is gathered in Oklahoma. So when the storage facilities get to near full, it means that whoever is producing oil doesn't have where to take it. And the complicating factor of the oil production is you don't just shut down and open up again. So the producers kept producing.
First, explain that for me. You don't just shut down. As someone who's not as technical as you, what do you mean there? You don't just, there's no off button.
There is an off button, obviously, in production. But the point is, one would ask, if the storage is full, why do they keep producing? To complicate the problem. The problem is that oil production is a very complicated process. You don't just go and shut the well today because storage is full and then open it following day. The process for shutting down wells, especially in the US, the production in the US is not similar to places like Saudi Arabia or offshore. A lot of production is from what we call shale oil.
Yes.
Oil is burnt or fracked underground.
Fracking, yes.
That entire process is so complicated that if you shut down production, the cost of opening up the production is very high. It's a bit similar when you leave your car at home during this COVID period and you don't run the engine once in a while, everything shuts down. When you come back, the batteries are down. So oil production is very complicated. When you demobilize the teams that are producing the oil and shut down the machines, when you come back to reopen, it's very expensive. So the producers keep producing. That's why you probably would have seen Trump saying, I want to talk to Russia, I want to talk to Saudi, to reduce their production, so that the global supply begins to what? To reduce, because the demand has fallen. If Saudi continues producing oil and Russia and the US companies continue producing, obviously the glut will be too big globally and the price of crude will keep falling. And that may continue or not, depending on how Saudi Arabia decides to respond.
Abdul, the elephant in the room is why doesn't that, I know we're talking about futures prices, but why wouldn't this reflect very, very easily on our petrol prices here in Uganda?
Many people have asked that question on different forums. The dynamics of crude oil are slightly different from the dynamics of what we call white oil, or purified oil, because the factors that determine the price at the pump are quite different. The one ingredient that is common is that there's crude, there's oil. But if you look at the factors that determine, especially if you bring it back home in Uganda, if you look at the price of oil, a significant percentage of it is logistics, it is tax. I think the tax currently is about 800. For every 3,800 you pay for a liter, government takes 800. So government is not going to reduce its tax because crude in the US is falling. Two, the logistics of moving oil from Mombasa, if you get closer to Kampala, is very expensive. Obviously, there's the cost of refining. So the cost of refining doesn't fall because the ingredient has fallen. So that process takes long. You're talking about between a month to 3 months for the fall in crude to begin to reflect on the pump price. But even then, it may not be significant. Now, I'm going to say something that might disappoint people who are anticipating the fall in price. Because a significant part of the cost is logistics, and we're in a situation of COVID-19 where I think in the next couple of days, government is going to issue strict regulations on movement of trucks, the price actually might go up in the near term, which will be contrary to what people expect. But that's what happens in the oil industry sometimes. But eventually it will go down, but in the near term it could go up.
But Abdul, now my reasoning would tell me that if the oil futures price for, let's say, June was in the negatives just last week, it's still not recovered particularly. Now would be a good time to buy June oil, stock up on that, get that delivered in June, if we still have reserves. Now would actually be a good time in order to have decent prices in June if we can binge up on June oil right now.
That's correct, but first of all, June, the futures price for June was not negative. I think it's around $20 for WTI and about 32 for Brent. But the point you're raising is correct. This is the right time to buy. The question is, who buys the oil? First of all, it's the traders. So we don't buy, I mean, most of the companies here, the trading companies, they trade into what we call white oil or white goods. So the traders obviously are buying, but they are already stocked up because of the logistics. Anybody selling oil here, whatever they are going to sell now, they probably bought it minimum a month ago or 2 months ago. Yeah. So before they change their price, 2 months have to lapse, first of all. The problem is what will have happened 2 months after. The dynamic globally could have shifted again. So it's very difficult.
You do raise some very interesting points. I've been alerted by my producers that most of our audience might not know what a futures and an option and a swap is. Now, a futures contract happens to be, well, like the word might suggest, a contract that if you have an asset that you're looking to sell or buy in a given futuristic sense, maybe 2 months from now, maybe 3 months, we could sign a deal with Abdul here and agree on a price and lock it in, and when that time comes, 2 months from now, that particular asset would be delivered. Now in this case, it is barrels of crude oil. Abdul, coming back to you, I hope my definition was right.
You're right.
I'm a little rusty on my CFA.
You're right.
Abdul, coming back to you, let's talk about something that's closer to home. The deal between Tullow Oil and Total last week sent a lot of jitters across the market. Is Tullow kind of just winding up and divesting from African markets and maybe concentrating on that big well in Guyana?
The answer is yes and no. I think well, I don't speak for Tullow Oil. I used to work for Tullow Oil, but not anymore, so I don't speak for them in terms of their strategy. But they position largely as an Africa explorer. So their farming out of Uganda last week is not necessarily a sign that they're exiting Africa, but it typifies what happens in the oil and gas industry. If you look at the history of many places, usually small explorers, relatively small independents, are the ones that take a risk, go into unknown frontiers, they explore the oil. Yes, they find it. Typically, when they find it, the big majors come in and do the production. The reason is because, especially in a landlocked country, it's a very long-term play. You're talking about 10, 30 years. In between, you find a lot of volatility in global oil prices, what we're just talking about. Relatively small companies cannot weather those storms when the prices fall, when there's political uncertainty, and all sorts of things. So for a company like Tullow Oil had to make a choice, whether they stay in Uganda, considering the delay in the project, or continue. But they also have other pressures around date from their bankers. So I think it's about portfolio rebalancing and actually really managing their debt. I don't think it is a strategy to exit Africa. In my personal view, I think they exited out of duress.
If at all, the pipeline went through the original plan, which was through Lokisha, go down to Turkana region in Kenya, then come down, maybe at some point join South Sudan up there. If that original plan had been adhered to and they went with that, as opposed to going through Tanzania, do you think Tullow would have stayed?
I would like to think so.
With their Kenyan interests in the Turkana?
I would like to think so, because that is a plan they had sold to their bankers and to their shareholders and to all their financial backers. And that plan did not work. So if that were true, possibly yes. But the most significant thing is that there are two things. At what point would the project in Uganda have taken FID? I don't want to say if the pipeline had gone through that side, the project would have taken FID then, because you have to remember there are three joint venture partners, Tullow, Total, and CNOOC. And obviously the biggest stakeholders there is government. So they still needed to agree on a number of things, commercial aspects of the project to move forward. So I can't say that if it had gone through that side,
it was a done deal.
It was a done deal, no.
Just maybe for our viewers, FID is final investment decision.
Yes.
Let's talk more about that. When do you see the final investment decision happening? Or maybe I should restructure that. What do you think is holding it up? Because we just keep on hearing 2018, no, 2020, it's like election campaigns now.
If you want me to give an honest answer, when is FID, I'll say I don't know.
No, what is holding it up?
If you ask me what is holding it up, I think there's been a number of things. One, obviously, is that all the partners, I'm talking about the joint venture partners and government, had to agree on a number of things. One of the big issues they needed to agree on was the farm down deal. Because Tullow could not finance its part in the project. You need to remember it's a $20 billion project, rather 20 billion project. So it started a process to farm down part of its interest to Total. It's a long story which most of the people in the public know. So, and obviously the tax issue came up. That process couldn't be concluded. It started in 2017. So that has been one big issue. Now that it is out of the way, you will say that there is optimism that you can take now further steps towards FID. But there are also other issues that they need to agree on. Obviously, one of the big issues is the fact that pipeline goes through Tanzania. So I think there's a big issue around what we call the host government agreements, agreeing the terms on which the project will be managed in each of the respective countries, Uganda and Tanzania. And in there, there's a host of issues that they need to discuss and agree on. Obviously, one big issue is the issue of the tariff, which they're still discussing. Having said that, I would like to imagine that the closure of the farm down deal between Total and Talo was not discussed in isolation of those other issues. So my optimism is that I think there's been conversation around all the issues. And what gives me more optimism is that this deal is slightly different from the other deals, because there seems to be alignment between government and the joint venture partners, including on matters tax. Previously, when the deals were struck, that is when government came out and said, oh, we have a position on tax. In this particular case, if you read the press statements, including the one from the Ministry of Energy, there seemed to be alignment.
Aligned on the tax issue.
So I want to imagine that all the issues were put on the table. When can FID come? It is very difficult because the ground has shifted because of COVID. But my optimism is that probably we'll see a bit of movement once the COVID cloud starts to lift. I'm sure there'll be more news.
Abdul, many thanks for making time to speak to us. How is Ramadan treating you, though?
Very good. I think during COVID, Ramadan is a blessing if you have a job and you're still earning. Obviously, it's very difficult if you're out of work and you earn on a day by day. So I want to call on all fellow Muslims and non-Muslims globally to help our brothers and sisters who don't have what to eat. But I think for those who have something to eat, it's a blessing.
I hear you.
And I want to encourage employers in future to give Muslims permission to work from home during Ramadan, because it's a blessing.
Thank the heavens, Nation Media does do that.
Okay.
Abdul Chibuka joining us. He's the CEO for True North, just breaking down all the technicalities of the oil space, final investment decisions, some very technical terms that are flying around. Thank the heavens I was here to be your lexicon. Let's take a quick break. We'll be back.